Good afternoon and welcome to the Pension Protection Fund live webinar to launch the 2018 Purple Book. Thank you all for joining. I'm Maddie Morgan-Williams and I'm your host for today's session. Today I have with me PPF's Andy McKinnon, Chief Financial Officer.
Good afternoon.
And Stephen Wilcox, Chief Risk Officer.
Hello.
Thank you, gentlemen, and welcome.
Thank you.
Thank you.
Now, for the next 30 minutes, Andy and Stephen will be guiding us through key highlights of this year's Purple Book, which provides a comprehensive overview of the defined benefit landscape and is now in its 13th edition. In the first part of the webinar, Andy and Stephen will talk us through the key trends and will present the numbers. We will then have time for questions, so please do start submitting your questions in the box below. I'll try and get to all of them, but any that I don't have time for, I will follow up with you after the session. The downloadable copy of the Purple Book will be made available on the PPF website later this afternoon. And here is a sneak peek of the print version, which is looking brilliant. So Andy, I'll now hand over to you to talk through scheme funding.
Thank you, Maddie. Well, the first slide you can see here is the Section 179 funding level. So that's a measure of schemes' abilities to pay out PPF compensation, which, if you like, is the risk to us. The headline you can see here from March 2017 to March 2018, schemes' ability to do that has increased from 90.5% to 95.7%, and almost exactly half of that movement has been driven by market factors. So primarily the fact that gilt yields at almost all durations have increased during the year, which has driven down liability values, but also there has been year-on-year increase in equity markets also, so asset values have gone up. The other thing that's going on that accounts for the other half of the difference is the update to the new data set. So we've updated our data. We published the 7800 index on a monthly basis, which is every other month. We're just estimating what's happened month on month. When we get to the end of the year, we get a new data set, and what we've seen here is an increase of 2.6% in the funding levels related to updates, for example, where schemes have done something different in their assets since last time we collected data, on anything else that comes from up-to-date scheme valuations, maybe undisclosed deficit reduction contributions and so on. So that's quite a positive picture. The other thing that we should just make really clear about these figures, the assumptions underlying the liability calculation are based on the assumptions that are in force at March 2018. A lot of viewers will know that we consulted on new assumptions over the summer. They came into force in November, and that will act to further improve the funding position. I'll come back to that in a moment. On the next slide, we can see a summary of what's happening to the asset values, which is the sort of pinkish red line at the bottom, and perhaps more interestingly, the liabilities, again on the Section 179 basis. And this slide gives you a sense of just how volatile those are. So whilst we've seen an increase year on year, perhaps the more interesting theme is the extent to which the liabilities do move month on month. And as I hinted earlier, that is primarily driven by gilt yields and the liabilities and the impact of that on liabilities. But at the same time, we can also see that we've had a pretty steady increase in asset values. And remember, this is a declining universe. So we've seen almost a decade-long bull run in risky assets, which has helped driven up the funding position also. I wouldn't be the first person to predict whether that's going to continue for how long, but it has been very much a theme of scheme funding over the last 10 years or so. If we move on to the next slide, just to show what has happened to gilt yields, which is what I mentioned as the biggest driver on the liabilities. As you can see, the different colours show gilt yields at 10, 15 and 20 years. And again, the really consistent thing is how volatile they have been. A good example of that, back in August 2016, we had a huge spike in gilt yields where they dropped down, as you can see there. That drove liabilities up, and we reported a record deficit of £413 billion back in August, which was almost double what we'd reported in either of March 2015 or the following March. And as you can see then, things have settled down a little, and by March 2018 the funding position that we're reporting now is close to where it would have been back in spring 2014. If I could just come back on the next slide and explain a little bit more about the change in assumptions. This slide is from the consultation that we did in the summer, and it shows the effect as at June, and this will roll forward into the 7800 index figures that we'll be publishing for the end of November from next month. And you see there the impact of weaker mortality and slightly less prudent discount rates, again showing another further increase of just over 5% in the liabilities. So based on the data then, you could see that funding level actually tipped above 100%, which looks like a very positive story. That is a very positive story. But at the same time, we should really emphasise that even with those new assumptions, we still have 3,188 schemes in the universe that are in deficit, and the combined impact of that deficit is still very close to £115 billion. So we are seeing some very positive figures. I think the key message over the last 12 months is that we have seen a lot of improvement in scheme funding, but it is still the case there's a lot of risk remaining in the universe, and it's great that the PPF is still here playing our part in managing
Absolutely, Andy. Well, thank you for that. And Stephen, I think you're now going to take us into a deeper dive into scheme demographics.
Absolutely, yes, Maddie. Thanks very much indeed. So let's look at the first slide in this section, the table, looking at where the members of the schemes we protect sit in terms of the size of the scheme. So from left to right, we've got the very smallest to the very largest schemes. And I'd like to focus first on the very largest schemes, those with more than 10,000 members. You can see it's a very small number of schemes, only 200. But those 200 schemes represent by far the bulk of the assets and the liabilities and the members that we protect. It's over 60% of the members. And that deficit sitting in that largest proportion of schemes is still quite high. Interestingly, at the other end of the spectrum, the smallest schemes, those with fewer than 100 members, there are 2,000 of these schemes, and interestingly these smallest schemes are in surplus. So yeah, very good to see that. It would be very nice to see some in aggregate some of the surplus figures going higher up. Now in aggregate, you'll see from this table we still protect 10.4 million members. That's a very good chunk of the UK population still. It's very slightly down from last year. We were at 10.5 million last year, but we're still in the business of protecting a very large proportion of people in the UK. And turning over to the next slide, this slide illustrates the status of schemes that we protect. The eye's probably drawn very quickly to the red line. That's the line of schemes which are closed completely to new benefit accrual, which has gone up over the last 12 years from 10% all the way up to 40% of the schemes in the universe. It's worth reflecting briefly on the purple line, which is the schemes which still have active members. Although the proportion of schemes with active members has stayed reasonably static, actually because the size of the universe has shrunk, the number of schemes with active members has actually shrunk quite a lot. We've called out a couple of numbers here. It was around 900 in 2012, and it's now down to about 660. So that's good to see a reduction in risk for members and for the PPF and our own members. And turning over, you can see on the next slide the active number of members we protect. Back in 2006, we still protected 3.5 million active members. We're now down to somewhere over 1 million. Again, a reduction in risk for those members and also for us is very good to see. Back to you, Maddie.
Great. Well, some fairly consistent trends there,
Indeed.
but fairly significant over the long term. Andy, I think you're now going to take us through asset allocation and what has changed over the last year. So over to you.
Thank you, Maddie. Well, this next slide shows the proportions of scheme assets that are held in the broad asset classes. Probably worth saying that this varies a little bit by the fundings of schemes. So better funded schemes tend to have a lower risk asset allocation than some of those that are less well funded. But what you can see here from the aggregate figures is, I think, a very clear trend continuing, and it's been very much a theme from back in 2006 when we very first started looking at this data. And as you can see from the top sort of pinkish red line, which represents equity share, that was more than 60% of holdings back in 2006. That's now fallen much lower, as you can see, in favour of increasing holdings in bonds primarily, but also over time increasing allocations to more diversified assets. And that's the blue line at the bottom. I think two things really to call out from the blue line. As you can see, it has been rising, but then starts to tail off towards the end. That's not really a reversal in trend. That's the inclusion of negative figures in cash as a result of schemes using gilt repos and derivative positions. But the underlying trend is also driven by more alternative assets and hedge funds in particular, perhaps worth noting. We're at the beginning of this chart, that represented about 1% of assets. By 2018, about 7% of overall scheme assets in that kind of investment. On the next slide, we look a little bit more into what's going on within the equity portfolio, and I think probably two themes worth calling out. One, as you can see from the blue line at the bottom, there is an increase in holding of unquoted equities, but perhaps much more stark is you can see the global diversification. So back in 2008 when this data started, we were more or less 50-50 between UK and globally invested equities. By 2018 we're seeing much broader diversification globally, and perhaps interestingly the net position of that for the UK stock market, that was representing well in excess of a quarter of scheme assets at the beginning of this trend, and by 2018 it's around about, as you can see from the chart, just about 5% of overall assets now invested in UK quoted equities. So I think that's interesting, and also interesting to see on the next slide the mix of bond holdings, almost precisely one third allocated between government fixed corporates and index linked bonds, and you can see that has changed quite significantly over time, and perhaps the most notable trend is the steady rising proportion of index linked assets within there, which represents a very significant de-risking of scheme portfolios, and is quite encouraging to see. And I think we could speculate that the impact of QE on these figures more generally, but I think overall the message that we take away from this, that over the last 10 years or so an awful lot of de-risking has taken place in scheme asset allocations on the balance sheet, and that's very encouraging for us to see.
Yeah, absolutely, Andy. Stephen, I think you're going to take us through risk reduction now.
Absolutely, or in fact carry on taking us through risk reduction,
absolutely.
Because the whole story is around risk reduction.
Absolutely.
And it's worth actually emphasising that Andy described changes in asset mix. Our estimates of sensitivities do show that has come through in risk reduction in schemes that we protect, so that's very good to see. But in this section what I want to talk about is some very specific risk reduction measures. Perhaps these are the ones which catch the headlines a bit more. And the first one is special contributions, which do remain high. You can see from the chart, which goes back quite a long way, that in 2004 when the current regime was set up, that did begin to encourage special contributions, which is good to see. However, what I would caveat is that the total amount of risk reduction from special contributions at 14, 15, 16 billion a year is a relatively small proportion of the assets and the liabilities that we protect at 1.6 trillion, excuse me. So very welcome, but still a relatively small number in absolute terms. Yeah. And if I turn over the page to the next slide, which looks at risk transfer deals, longevity swaps, buy-ins and buyouts. Again, it's the same sort of story. Quite a high level of these kind of deals, which do very effectively reduce risk. We estimate about 22 billion over the last year. But again, I would caution that in the context of a 1.6 trillion assets and liabilities level, that is relatively small, and that would need to continue at that level for a very long time to have a very significant impact on risk.
Yeah, so the context is really important there,
Indeed,
isn't it?
indeed. And if I turn over to the next slide, which looks at transfers out of the pension schemes that we protect. So this is by and large passive de-risking, if you like, by members themselves. You can see very clearly the impact of pensions freedoms in 2015. The amount of transfer out has gone up a lot since then. We do know that FCA and TPR, of course, are taking a look at this to make sure that members are getting the best advice and are taking the right decisions for themselves. But again, in absolute terms, in terms of risk reduction, the numbers are fairly small. We're looking at, 10 billion or so a quarter. That's, again, in the context of the figures, relatively small. Now, in the context of all this de-risking, it would be nice to think that recovery plans are coming down in length. However, from the next table, you can see that actually, by and large, that's not happening. We started out in 2005 with recovery plans averaging 8 years or so. 11 years later, which is the latest set of data we've got, again, we're still looking at recovery plans stubbornly high at 8 or so years. And I think part of that explanation will be the chart that Andy showed earlier around gilt yields. There may be other explanations, but it would be very good to see those recovery plan lengths shrink, because that would protect members much better.
Absolutely.
So if I can finish just by reflecting a little bit on the PPF itself. We've looked a lot at schemes and how they're de-risking. This next chart compares PPF funding levels to the funding levels of from the 7,800 index of the schemes we protect. And you can see from the purple line that PPF funding levels have continued to trend up. We're now at over 120% funding level, which is very good to see. Whereas by and large, scheme funding has been volatile, as Andy said, but has remained relatively static. So it's very good to see the PPF in a robust position, ready to stand protecting any scheme which needs to claim.
Yeah.
And if I turn over to the next slide, reflecting on the claim levels, this is insolvency rate. So this is the insolvency rate of sponsors of schemes. And viewers will see from this chart that actually the insolvency rate has been quite low for a number of years, which is very interesting to see given economic circumstances. It came down in 2013 to 2014 and remains at a very historically low level. That's in terms of numbers of insolvencies, though of course people will be aware that last year we had our highest ever claim level in cash terms, and also that since that year end in March there have been a number of other insolvency events which have or might or will give rise to more claims on PPF. So it's very good to see that from the previous slide that we have that robust funding level. So if I can wrap up with some key insights from the Purple Book as far as I'm concerned, the first thing, as we've said all the way through, is that schemes are doing a lot of de-risking, and that is very welcome. However, there is plenty of risk out there within schemes, and for as long as there is risk within schemes, there is risk to the PPF and to our members and to the members of the schemes that we protect.
Yeah.
We are, however, in a solid position. We are still financially robust. We are a long-term business. We are in the business of preparing for long-term futures, and we are as prepared as we can be at this stage. Thank you.
Great, thank you, Stephen. And Andy, would you like to add some final thoughts to that before we go on to questions?
Sure, thanks, Maddie. I mean, just to summarise, we have seen some very positive things from the data. It would be great to see, when we're sitting down this time next year, continuation in the activities in schemes around de-risking. In particular, I think there is some good practice about schemes planning for their end game now, and it would be great to see more of that. As you know, I think Stephen mentioned earlier, we've also seen some very significantly large de-risking transactions in the market as well. So there continues to be a lot going on. As we also mentioned when we collected the data this year, that was largely a good news event. So, be that undisclosed deficit reduction contributions, be that new initiatives taken with schemes that we were not aware of, that's all very positive, so it would be great to see that continuing also. But in summary, year on year the position looks much more positive. There is still 149 billion of Section 179 underfunding out there. We are in a very uncertain economic environment, and we have more recently seen a bit of a return to market volatility. So I think there's a lot of risk out there. We continue to be well prepared for it. We've seen some evidence today that schemes are increasing their preparations for uncertainty, and I guess I will just close by saying we are in a relatively positive position. I think we feel that the PPF is well prepared for any scheme that needs our help in the future.
Thank you for those final thoughts, Andy, and thank you, Stephen. I think that's a good opportunity to go into some questions. And Stephen, as you quite rightly said, risk has been a very common thread throughout this discussion. And we've had one question here asking you specifically, do you think schemes are doing enough to reduce their risk?
Anything schemes do to reduce risk is good for members, it's good for us, it's good for the members we already protect. And we've seen from the data we've shown here that schemes are doing a lot to reduce risk. And to be honest, anything that schemes do to reduce risk is very welcome for the benefit of their own members and for the benefit of the PPF and its members.
Absolutely. And another question on risk we've had in, is the recent rise in risk transfer deals a concern for the PPF?
Absolutely not. No. We are delighted by any kind of risk reduction measure because it does protect members. You know, we are here to protect both the members we already have, but also the schemes and the members that they have. Any sort of risk reduction deal is good for those members.
Absolutely. Now, we've also had a couple of questions about the PPF's funding horizon. You've previously mentioned that this is 2030. And Andy, is this still the case?
Well, 2030 is an estimate of when we will meet our funding horizon. Interestingly, given some of the things that have changed since we first mentioned that, it remains broadly about the right period of time, in spite of the lengthening of recovery plans, as we spoke about earlier, and a number of other things that have changed significantly over that time. We do continue to review our funding strategy, but as of today, happy to say that we remain on track for it, and we're well funded to stand behind the members of schemes when they need us.
Good. There's sort of a lot of talk about sort of the PPF being self-sufficient at 2030, and has been much talk of that in the past. Does that mean that there will be no levy?
I'm afraid it doesn't. I think what you've seen today, there is certainly a trend towards scheme closures, but there are still almost 10.5 million members of schemes, and there is still a lot of underfunding there. So it is our expectation that even when we've reached a point in time when we're well funded to continue to pay all of the members that will then be within the PPF, if it remains the case that schemes continue to be underfunded and sponsors continue to go insolvent, then we are likely to need some degree of levy to cover those.
Absolutely. We've talked a lot today about uncertainty, and Stephen, you looked at the insolvency rates and potentially the trends and where they're going to go, and I think Brexit is a big uncertainty on the horizon. What impact do you think Brexit could have on scheme funding, potentially in the event of a no deal?
Shall I start with that one?
Please do.
Clearly, we don't know what's going to happen. There are all sorts of things that might happen over the next week or month or several months. There are some very extreme possible scenarios still. In some of those scenarios, there will be stresses on scheme funding. We have analysed the potential impact of those stresses on us and on the universe, and we are still robust. I'm still confident that we will have the funds available in those scenarios. It might also be worth saying that we've done, as you'd expect of a large financial institution, analysis of our operational exposure to any potential extreme version of Brexit, and again, I'm confident that we are robust in that area as well.
Great. Andy, do you have anything to add to that?
I would add only that I think we do invest a lot of time and intellectual capital in our modelling, and we do consider a very, very wide range of economic scenarios. And the important thing for what we do is that we're financially robust in the long term. I think you saw on the figures earlier what happened after the Brexit vote. Last time there was a huge shift in liabilities, but it was relatively transient.
Yeah.
So I certainly don't underestimate what could happen. I'm certainly not going to speculate about what might happen, but I'm as confident as we can be that we're as resilient as possible for whatever might happen.
Good, thank you. Now, we've had a question in on how have mortality and longevity trends impacted scheme funding?
Goodness me. It's very obvious that over the long term, we've seen a increase in longevity. People will be aware that over the last 2 or 3 years that seems to have dampened down. Now, I don't know to what extent that's been reflected by scheme actuaries in the assessment they've done. From our perspective, it's certainly something we are aware of. We look at fairly regularly, and we will be looking at again to find out, to work out what potential impact of longevity changes might be on us in the long term.
Yeah. And another question in from the audience watching: what is your view on consolidators?
Oh, well, as I've said a couple of times, the PPF is well prepared to stand behind members of schemes when they need to come to us. But I think consolidators could certainly play a very significant role in giving members of schemes and scheme trustees more options. So I think that could and should be a very positive thing. I think the important thing for me is to make sure that commercial consolidators are well funded and in particular well regulated.
Absolutely.
And it's probably worth just adding that clearly we are aware that if consolidators do take off in a big way, that may potentially change the nature of the risk we protect. That's what we're here for, and our job is to make sure that the risk is understood and that we are well placed to respond to it as we need to.
I think that's a nice segue into our final question, which is probably for both of you, actually. So what do you think the future holds for DB pensions in the UK? Stephen, would you like to start?
At one level, who knows? I have no crystal ball. My job as a risk person is to think of a wide range of possible scenarios which may come about and understand the nature of those scenarios on the PPF. Certainly, there's been some speculation that there might, one possible scenario might be a resurrection of DB. I can see that might happen. It's certainly not a central scenario for me. But again, our job is to respond to whatever the future holds and make sure that we understand it and can respond to it. Yes,
absolutely. And Andy, anything to add to that?
Well, I think you've seen from the figures we've shown you earlier that there has been, certainly over the last 10 years, a relatively steady trend in schemes closing to new accrual and to new members. But I think the other thing to remember is that there are still 10.4 million members of those schemes. They are 1.5 trillion of assets. So I think we should just continue to focus on that being a very large section of the population who continue to depend on defined benefit contributions for at least a part of their retirement planning. And PPF is here to play our part in making sure that's continued to be managed, even if schemes are not opening in large numbers today.
Of course. Well, that's all we have time for. Thank you, Andy. Thank you, Stephen.
Thank you.
And thank you all for watching. We'll be sharing a digital copy of the Purple Book with you all shortly, and there will be an on-demand version of this webinar available on the PPF website tomorrow. The address for that is www.ppf.co.uk. Many thanks.
Thank you.
Thank you.